Hi everyone, this is Day Trading Crypto Scalping, and today we will answer the question of what are knives and knife catching. Let's look at some charts examples to see what a knife is, what is the point of catching it, and then we see video examples of trades with knife catching. What is knife formation? A knife is an impulse directional movement in a short period of time for a sufficiently large number of percentage. In other words, this is a huge spike up or a spike down. Spike down is a powerful fallen impulse movement. Spike up is powerful up movement. I got a few examples for you. These are examples of impulse fallen movements. For me, catching knives on the spikes down is more understandable. I use them more often. Therefore, I have collected several examples of it. The first example is a knife formation on XLM chart, 5-minute time frame and a powerful fallen movement. We get about 10% in 10-15 minutes of the down movement. The 10% of short movement I mean. And then bounced on the resistance, because the buying prints are over. What is spike down? The knife is formed on correlation instruments, on fallen Bitcoin, on fixing the position of longs, positions that previously held it long, and in the case that participants close their positions, and also it occurs if participants into the shot. At some point, our selling are running out, correlation instruments are reversing their side and the movement is changing. Here we see a deep pullback, more than before. It's not always like that. Then we'll see an example of a trade with a knife catch. An example of an ADA coin 5-minute time frame, moving from $15 to more than $12. In percentage, this is about 22% change. And the exact same peak moment is the liquidation of the positions of the participants. Binance has open information of liquidations. These are large market prints when Binance closes the positions of participants itself. And here we see the peak moment. This is the final, a huge spike down, maybe a large volume of liquidations, and then a pullback when we see the end of selling and the reversal of correlation instruments. There are two examples on XRP coin, two examples of a knife formation. One knife is weaker, another stronger. We see powerful impulse directional movements in a short period of time, which have the final peak stage. As a rule, the final moment consists of the largest volume of liquidations, closing positions, turning the correlation instrument, and deep pullback. The point of catching a knife is to see the peak moment when our movement has completely formed, when the market trade history decreases the amount of directed prints, when the correlation instruments reverse in its direction, when the clusters reverses too. While we catch a knife, our goal is to see the peak moment and try to enter at good prices. Our goal is to sell high or buy lows. Final chart example of XRP coin. We see a spike up. This is a rapid impulse directional movement up and a peak point where you could catch a knife, and then a deep rapid pullback. I mean the spike down of the price. And also a peak point with a good rollback. This strategy is high risky, because you and I are entering against the trend. As a rule, there is no clear point for the stop loss. This strategy involves a high risk and I don't recommend using it without a full understanding of the situation. Let's see some video examples. There was a recent spike down, a recent correlation. Here the first trade will be on XRP coin. Now I will show you 5-minute chart. It was here. We have formed a powerful falling movement and you will see my attempts to catch this movement. I started in advance. I was not waiting for the final peak point and I can say that is dangerous, because you can hurry up and keep your position in minus. And it happened around this point. Let's see. We have active selling, the price falls quickly and impulsively. Then we hit a huge volume amount and the price doesn't go lower. The price stops. Active selling stops and I see buying prints. I enter too long at the market and I make a mistake. We had a slight pullback. And also there is an active selling. I don't have time to close my position. I try to close it at market, but I notice that instead of market order, I have a limit 1, and my position is getting down. Here I hope for a quick pullback, and I don't want to close the quick loss. And here, when it rolled to 0 and it was possible to close, I placed a limit order above, and unfortunately the market didn't execute my position. The only thing I was lucky about here is that I placed a small part of the position below my price. A loss continues to hold on to the rest of the position. I see 2 million on spot. I decide not to close my position. I suspect that we can bounce back. And at the moment when we begin to roll back, we see that previous active selling prints are beginning to slow down. We see that there are fewer prints for selling, especially on spot. The moment begins to change and I begin to average my position. I average it with limit orders and here I have already gained quite a good amount. I decide that 2 million on spot will be eaten. Then I will immediately close my pause. Because I can hold an unprofitable position further. This is a dangerous strategy. I wide enough stop loss and not always the ability to clearly place it, so be careful. There was a quick rollback. I closed most of the position in plus and the final part also in a small plus. Then there was similar trades and an attempt at rapid pullback, which already ended without setbacks or quickly closed in small plus or minus. Quite controlled for a small volume. Now I ask you to pay your attention to XLM coin. This is the second order book on the right. A very similar situation was formed here. Let's see it. This is what I showed in the screenshot in the example. In this case, this is almost the peak moment. Here we have the first attempt to knife catch here. And the final attempt was at the price of 18.80. Let's see. We are running out of active selling. We see that participants start to buy the instruments well and place long prints at the market price, and I am starting to open positions. I open a position at the market price. I'm opening long at the moment of buying back the price. Because of the pink and volatility, I don't have time to close the quick rollback of more than 1%. I get a spike down, and I close my position without any loss because I don't want to hold loss position. When I see that we are not going up, the correlation instrument has not reversed its direction. The price doesn't pull back, and that is why I plan to close it. Here it got 1%. I began to close the position partially and hope for further movement up, and when the price began to pull back, I closed it at the market. Let's look at the final trade. This is a trade priced at the 18,100. It was the low. Everything here is clear and simple. Local low, Bitcoin begins to reverse its side. The movement is understandable. Below we see a large limit order. I enter from it for 250,000. I place a stop loss near that order. And in case of a minus, I'm preparing to close behind it and waiting for the pullback. Generally we see a pullback, then the price spiked down and as a result the price began to go up. I began to close the position in area of 2% profit. Let's see. There was a little spike down. The price approached my entry price of 18,560. We formed a small triangle and began to pull back. We see 2.5%, 3%, and part of the position close to 3% profit. And for the rest of the position managed to earn up to 4%. This is a great example of knife catching trade. Thanks for watching, ask questions in comments, have a good trading session.